afternoon, everyone. Very happy to address you all today. I hope you all are having a good day so far. And today I'm going to talk about how we can use quant strategies to invest in India for sustainable alpha. So there are four key topics we need to address here. The first is India. The second is why quant is the future of investing in India and world over. And the last one is how do we generate alpha and how can that alpha be sustainable? So before I get into the details, a brief introduction about PL Group. We've been in the business for the last 8 decades since 1944, operating across investment banking, institutional equities, asset management, wealth management. We also have our own NBFC, and we are also part of the broking and distribution industry. The key pillars that PL has been built has been trust, transparency, and integrity. And we've been an award-winning brand in India, known for our trusted financial services to multiple individuals, institutions, and corporates. And be rest assured that we've done our homework because we've been around for the last 80 years. So if we're talking about something and if you've worked on something, there's a lot of experience and wisdom that's backing it. Now, a little bit more on quantitative investing. Quantitative investing represents a very, very differentiated and innovative approach to investing. It uses data and technology to make investment decisions. And the approach PL has taken to do this has been a man with machine approach. What that really means is we combine the human intelligence that the group has been known for the last 80 years and use technology, cutting edge technology, to convert that into processes, systems, and decision-making frameworks. And a little bit more on India. I think nobody needs to sell the India story anymore because everybody is fairly convinced that India is the economy to be and India is also the market to be. But just to summarize it in 2 points, every market or every investor to make money in any market needs only 2 key factors. One is growth and the second is multiples. And I think India has both of them firing on a structural basis for it. So let's look at the 4 key growth engines India has. The first one is cyclical growth. The second one is structural growth. The third one is secular growth. And the fourth one is emerging growth. So when we talk about India, I think with the government, with the industries, with the private consumer demand, all the cylinders are firing very, very heavily. And when we talk about multiples, the only thing we need to understand is that global flows, local flows, stable macros, and stable geopolitics, these are the 4 key factors that drive multiples to a higher range. And given India is the fastest growing economy in the world and headed to be the 3rd largest economy by 2028, we should be rest assured that our multiples, the premium multiples, will sustain for the decade to come. And this is just a quick snapshot of some data points that help us understand how the flows will support the multiples. If we look at, say, demat accounts, in FY18 versus FY23, we can see a massive growth, 23% demat penetration now as opposed to 8% 5 years back. Similarly, if we look at the MF book, we're standing at a 50 lakh crore MF book and a SIP book of close to, monthly SIP book of close to 18,000 crores. Every other industry data point which talks about financialization of savings, whether it's growth in the MF assets or growth in the PMS assets, makes it very, very clear that India is going to be infused with a lot of capital, not just locally, but also globally. And over the last 3 years, we've also noticed that every correction has been a buy on dip correction in India. None of the corrections have been deep or major or lasted for a very long time. That is simply because the domestic participation, the retail participation has been very, very strong. Finally, let's talk about numbers. How does this all add up? So if you look at the last 18 years, India has been among the best performing markets in the world. And the top 5 markets, the top 5 indices have India representing 3 of them. So if we look at the small cap returns, the mid cap index, and the Nifty index, they do feature among the top 5 indices. This is simply an average or a mean return of the last 18 years. And I think barring NASDAQ, which is a tech-oriented index, all the other major indices fall from India. So this really shows how the macros, the markets, the flows, everything is adding up together in returns. Finally, we need to address the major topic that I'm here for today, quantitative investing. I think data will prove why quant is going to lead the big wave in India as well over the next decade. So in India currently, less than 1% of all the money is managed quantitatively. When I look at America, I think that number is at 35%. So India is still managing 99% of all the assets using active or passive methods. But when we look at America, only 65% is using active and passive methods, but 35% is using quantitative methods. And for quant to grow, you simply need an amalgamation of data, technology, and talent. And I think now is the best time that India has ever seen in terms of all three. And if you look at the breakup between 1998 and 2023, this is going to show you the complete picture of how the asset management industry has evolved in the more developed markets. So in 1998, 11% of the money was managed passively, 89% of the money was managed actively. Now let's look at 2023. Only 26% is now being managed actively, but 35 and 39% is managed passively and quantitatively. I think this data shows how big the shift from active money management to passive and quant money management in India is going to be. Finally, if we look at the growth of quant funds in India as well, I think it's grown at a 232x in the last 10 years. We're currently at close to 63,000 odd crores, which is still very, very small compared to the industry of close to 50 lakh crores in MF and close to 5 lakh crores in PMS. So I think there's a large runway for these assets to grow over the next decade. And what is driving the growth of quantitative funds? I think the answer is very, very simple. It's the performance. Passive funds are low-cost strategies, active funds are high-cost strategies, and quant funds fall in the middle of both of them in terms of cost. But where they stand out is the performance. So I think 91% of all the quantitative funds in India have outperformed their benchmark over the last 5 years, as opposed to just 39% in the active category. And I think that is the big reason which will lead the shift from active and passive money management, which is currently controlling more than 99% of Indian assets, to quantitative money management, which is just below a percentage as we speak. And finally, we need to understand that why do we believe that quantitative research and quantitative investing is the future? I think humans come with a lot of intelligence, but they also bring a lot of emotions. The moment we move to a quantitative approach, we try to retain all the intelligence in terms of rules, in terms of models, in terms of frameworks, and in terms of strategy design. But what we are essentially trying to do here is to eliminate all the emotions out of the investment decision process. And I think the biggest problem in India that we've seen over the last 2 decades is that markets operate in styles. They operate in different regimes and they operate in different styles across different cycles. For example, we've illustrated a couple of key investing styles that we see not just in India, but also globally. And what we are seeing here is that when interest rates are going up, a value style of investing does better. When there is a lot of liquidity in the markets, a momentum style of investing does better. When there's uncertainty in the economic environment, we see a quality style of investing do better. But the problem here is one style doesn't work across market cycles, and an individual fund manager will find it very, very difficult to change their investing style based on the investing regime that is prevailing. So we need to take a quantitative, objective, and data-driven approach to make sure that our strategy is adaptive across the different style regimes. So this is just a snapshot to show you how between 2013 and 2023, we've seen different investment styles coming in on the top spot and different investment style coming in from on the bottom spot. So just to give you an example, in 2013, growth was the best performing style, but in 2014, it was the worst performing style. Similarly, in 2016, value was the best performing style. In 2018, value was the worst performing style. And the simple idea here is we can't be fixated or biased towards one style. We need to be adaptive across the different styles. And the way we do it is every time we see a risk on phase in the market, we need to tilt towards growth and momentum. Every time we see a risk off phase in the market, we need to tilt towards quality and low volatility. And every time we see a risk transition phase in the market, we need to shift towards value. And our strategy incorporates some of these features in the investment decision process. And with that, I would like to show you how over the last 15 years, some of these factors have done as an individual level, how have they performed at a combined level, and what kind of value can be added if you actually bring the adaptive nature into these factors as well. So just to give you a simple example, the moment you look at, say, volatility as a factor, it's delivered 16% CAGR over the last 15 years. Similarly, if you look at small cap as a factor, it's delivered 17 or 18% CAGR over the last 15 years. But the moment you combine all these factors and use a multi-factor approach, it brings your CAGR up to 33%. Your drawdowns down to 33% as well, as opposed to some of the higher drawdown factors that we see. And the moment you give it a style tilt, which means combine the different factors, but give more weightage to the factor that is currently prevailing in the market environment. For example, if we were in a value regime, then value would get the highest weight out of all these different factors. And that's what we call a style tilt. So Aqua, which represents a strategy which has a style tilt in it, brings your CAGR up to 39% over the last 15 years. So the whole idea is, don't use a single factor approach to investing because it doesn't work across market cycles. A multi-factor approach to investing is superior than single factor approaches. And finally, if you are able to add a style tilt layer to it, that will push your CAGRs up even higher and make your risk levels also significantly lower. And with that, I would like to introduce you all to the strategy that we're going to talk about today, which is called Aqua. Aqua is India's pioneering style agnostic and style adaptive investment strategy. It's a flexi cap equity PMS, which means it can invest across large cap, mid cap, small caps, and also go into cash in certain regimes. Aqua is basically inspired by water. The way water can take any shape, any size, any form, any color. We wanted to come up with an investment strategy that could do the same in terms of styles, in terms of sectors, in terms of asset classes, in terms of beta levels, and in terms of security selection as well. So the whole concept behind Aqua, we've taken 5 years and a team of 20 quantitative research specialists ranging from macroeconomists, risk analysts, financial engineers, Python programmers, statisticians, mathematicians, fundamental analysts, technical analysts, and ML engineers as well. It's a team of 20 who's come together for the last 5 years to design this strategy. And I think we've been live now for the last 7 months. We've delivered returns, absolute returns of close to 60% in the last 7 months, which is an alpha of 40% over Nifty and an alpha of 34% over the BSE 500 broad benchmark. And what Aqua pretty much represents is 4 things: an adaptive, quantitative, unbiased, and alpha-focused investment strategy. And when we talk about adaptive, I've given you all a brief of how we are adaptive across the different dimensions of investing, from style to sector to asset classes to beta to risk levels. We take a quantitative approach to do this because it is extremely difficult to do this without a well-defined process, well-defined systems, and 100% data orientation. So there is no human intervention in the investment decision making to select the stocks or construct the portfolio. All the human intervention and human intelligence is brought in to actually design these systems, not to alter the output of these systems. Every time we have a problem with the output, we go back to the process and try to revise the process rather than tampering with the output. Finally, this is an unbiased approach, which means we have no holding period biases, we have no style biases, we have no fundamental criteria biases, we don't have any sector biases, we don't have any management group biases. These are all the biases we're trying to keep out of the investment process and focus on the data and let the data govern our investment decisions. And the final end outcome of any investment is alpha. I don't think anyone who's investing in an AIF or a PMS is investing to earn returns. There are a lot of low cost instruments in the world available to earn just returns. So the objective that you guys are putting a lot of money in specialized PMSs and AIFs is not to earn returns, but to earn alpha. And the whole focus of Aqua is designed around alpha generation. And the way we try to generate alpha is by integrating 5 things in the investment process, whether it is the right asset, which drives close to 91% of all the investment returns, the right style at the right time. So that enhances returns by close to 69%. The right theme or the right sectors, that enhances returns by 75%. What that essentially is trying to tell you is that even if you pick a good stock in the right theme, you're much better off than picking the best stock in the wrong theme. And the fourth pillar is right factors. When we talk about right factors, we're essentially saying that instead of using one factor to make your investment decisions or 2 factors, use a multidimensional approach to make your investment decisions. And the final point is right beta. So markets operate in 3 key risk regimes, as I explained: risk on, which is your high beta regime; risk off, which is your low beta regime; and risk transition, where your beta is moving from either high to low or low to high. If your portfolio is able to navigate these beta cycles very in a dynamic and agile way, then I think over a short term, mid term, and long term, you should be able to add on to your alpha. And finally, with that, I would like to tell you all that in the era of man versus machine, we are going with the approach of man with machine. We don't believe that machines alone are superior than men. We don't believe that men alone are superior without the use of machines. Given that we have the technology that we have available today, I think integrating the best of both worlds is going to represent a very, very sustainable approach to investing. And these are some of the key biases that I spoke about. Whether it was sector bias, market cap bias, management bias, behavioral bias, key man bias, all the investment decisions are solely dependent on me. If that is the situation, there's a lot of risk for investors. You know, if I'm unwell for 2 months, who makes the decisions? So we believe that a process-oriented approach is more superior than a person-oriented approach. And finally, with that, I'll introduce you all to the investment framework behind Aqua. I think we've taken a lot of time to get this all together. It's called the 6S framework. We talk about 6 key things here. We start with sector rotation. In Aqua, we don't believe that having a benchmark bias or a benchmark hugging approach to constructing portfolios is the way we look at investing. For example, in the 2022 cycle, we had 0 allocation to IT as a sector. And in 2023, we had 45% weight to industrials, which captured the entire capital goods, engineering, defense, railways, shipping, that entire piece. We had close to 22% allocation to automobiles. We also have had significant allocation to diversified financials and 0 allocation to private banks. And by diversified financials, I mean PSU banks, PSU NBFCs, the capital market exchanges and the brokers and asset management companies. So benchmark weight for financials is close to 33%. Aqua, we had a weight of close to 36%, but without having a single private bank. But the benchmark weight is dominated by private banks. So the whole idea is, we believe that sector rotation and a sector agnostic strategy to constructing your portfolio is more superior in terms of alpha generation rather than a benchmark hugging strategy. The second pillar of the 6S framework is style alignment. As I explained, markets work in cycles and regimes, and we need to ensure that your portfolio is able to take the relevant style tilt at the right time so that we don't see long cycles of underperformance. For example, if I'm running a value-oriented fund and the value cycle is not in my favor for the next 3 years, that means for 3 years, my fund would likely to underperform simply because I've not been able to change its portfolio style. With Aqua, with maximum a lag of 1 month, we are able to realign the portfolio to the current investment style. The next S of the 6S framework is superior fundamentals. When we talk about superior fundamentals, we're not saying great fundamentals. Superior fundamentals talks about an approach of relativity. What that means is, we're looking at companies that are relatively better off than their peers, relatively better off than their past, and relatively better off than the broader markets. When we try to combine stock selection using three principles, we aim to identify stocks which have relatively better fundamentals, relatively sound valuations, and relatively stronger technicals. We don't want to buy companies that have great fundamentals, but the valuations are not supportive, or have very, very cheap valuations, but the fundamentals are not supportive. And finally, if the fundamentals and valuations also come together, we want to ensure strong technicals, because long-term investment or long-term investment returns comprise of multiple periods of short-term in between. So you cannot earn alpha in the long term without actually earning alpha in the short term. So technicals help you augment short-term returns and manage short-term volatility as well. So our stocks actually blend all these three. And the last S of the success framework talks about smart risk management. When we talk about risk management, we ensure that we are able to change the asset allocation across large, mid, small caps and cash as per the market cycle. We're able to tilt the portfolio beta as per the market cycle. At the same time, we eliminate 100 stocks based on liquidity and 100 stocks based on fundamental red flags from the top 500 universe of India by market cap. So essentially, you're left with a 300 stock universe, which has more liquid stocks and relatively better fundamental stocks as well. And the idea is to manage risk across market cycles, we also need to take care of the sector and style risk. If the sector orientation in the market is changing, our portfolio should be able to adapt to it as well. And similarly, if the style orientation is also changing, our portfolio should align to it. And these are some of the proprietary factors that we've constructed in order to be able to apply the success framework. All of these factors, whether it's value or sentiment or risk or liquidity, have multiple sub-parameters in the range of 30 to 50 sub-indicators to gauge risk, valuation, macros, monetary, etc. for every security. And finally, the way we construct the portfolio is every security gets a score on all these factors, but the weight given to these factors changes as per the investment regime. And finally, we construct a portfolio of 25 stocks with 4% each, equal weighted, in order to give you a portfolio that is more resilient and dynamic. And this is the broad process that I was explaining y'all. We eliminate and filter 200 stocks from the top 500. We then focus on sector evaluation and style mapping. We then provide a rating to each and every security and construct the portfolio thereon. And finally, the job is to dynamically and continuously manage risk for the investors. And now addressing the big topic, the fourth and the final topic for today's session is how is Aqua designed for alpha generation? I think there are four key sources of alpha here. The first source is elimination. The second source is selection. The third source is allocation, and the fourth is rotation. When we talk about elimination, not having chemicals in my portfolio for the last year, or not having IT in my portfolio, or not having private banks in my portfolio for the last year, that is alpha by elimination. Alpha by selection represents having capital goods, having PSUs, having automobiles, having diversified financials. Alpha by allocation represents that when the benchmark weight for industrials is at 8%, if Aqua is at 45%, that is alpha by allocation. And finally, alpha by rotation means that December onwards, we've started increasing the allocation of IT in our portfolios. So we've rotated out of some sectors and moved into some other sectors. So when you do this on a continuous recurring basis, I think that is a great recipe for sustainable alpha. And again, these are some of the various sources that we generate alpha from. I've already explained this. And the other important thing to understand about the alpha is, why is this sustainable? Why do I think, why do we believe that this will continue to happen? Firstly, the alpha is not concentrated. It is very, very granular, which means not 10 or 20% of my stocks are contributing to the returns of the portfolio. 70% of my stocks are actually outperforming their benchmark in their holding period, which means it is very, very granular in nature. How is it granular? Because we don't allocate more than 4% to any security at a given point in time at the time of entry. Which means for my portfolio to give you a 20% return or a 60% return like it has in the last 7 months, most of the stocks have to do well and beat the benchmark. Only then is the alpha sustainable. And why is this happening? Because it is a process-driven method to constructing the portfolio. For the last 7 months, I have not picked a single stock in the portfolio. Neither have I picked a single sector in the portfolio. Neither have I decided the weights for any sector or stocks in the portfolio. And because this is a personality agnostic approach to manage money, we believe this alpha is very, very sustainable. And the process is rooted in a multi-dimensional approach. We don't look at one thing, we look at multiple things. And finally, if you look at the returns of a strategy like this, it's very, very important to understand that we've been consistent month on month and rebalance on rebalance in generating this alpha. So every time we've constructed the portfolio, whether we talk about the first 4 rebalances, if you look at the alpha column, it's very clear that in the 6 to 8% range is the alpha that we've been able to generate in this cycle. We also need to acknowledge that the markets have been very, very supportive. And this is a bull market. But even in a bull market, generating a 35 to 40% alpha is not easy. And when I look at my returns for each and every period that has gone within, you can see that the alpha is in a very, very consistent range. And the final thing with which I would like to close today's session is talking about how granular, repeatable, and consistent alpha is, even across the back test of this strategy, which we've done since 2006. So when we look at numbers, if we get it right or if we get it wrong, the way we measure right or wrong is if we've outperformed the benchmark, we've got it right in that period. And if we've underperformed the benchmark, we've got it wrong in that period. So on a monthly basis, we've outperformed for 65% of all the periods since 2006. On a quarterly basis, it's more than 77% outperformance. On a yearly basis, more than 88. On a 3-year basis, more than 96. And on a 5-year basis, it's close to 100. But the idea here is this also means that 35% of the times we could be underperforming on a monthly basis, and that's still part of the strategy. It's still acceptable. Now, the important thing to understand is all these numbers are very, very encouraging and show how sustainable a strategy like Aqua is in making sure that we are managing risk dynamically in a responsive way. At the same time, we are generating alpha that is derived from a process and not from a person. And with that, I think my time's up for the day, and I would love to speak about this for another hour if I could, but today is not possible. So let's interact, personally and outside the forum as well. I'm here for the whole day. Thank you so much for being such an attentive audience, and it's a pleasure interacting with you all. Thank you.